All right, well, let's kick off. Time is of the essence. Welcome to the Weno trading floor. For those of you who don't know me, I am Bryce. I'm co-founder of Equity Mates. Welcome to FinFest 2022. You're in for an absolute treat. We have some of my favorite guests on the show. So the session today is how to find those hidden gems with Scott, Phillips, and Andrew Page. With thousands of listed companies, finding hidden gems can be incredibly difficult. Have no fear though, as we have two experts here to talk you through it. Getting a bit of feedback, but Scott Phillips is Chief Investment Officer at the Motley Fool, and Andrew Page is the founder and managing director of strawman.com. Obviously a disclaimer, anything you hear today is education and entertainment purposes only. So I do want to do one quick thing before we get going. I'm going to need a bit of energy because I want to go around the room and get a video for my socials. So if everyone can do a bit of like a Mexican wave starting from this side, and we're going to go around the room like that, and then we're going to welcome on Scott and Andrew. So ready? 3, 2, 1, Mexican wave. Let's go. Hell yeah. Woohoo. Woo. Nice. All right, without further ado, let's welcome Scott and Andrew for how to find hidden gems.
Good morning, everybody. You probably know the Motley Fool. You probably know the Motley Fool because that bloke bags us on social media about every second week. You may not know strawman.com. You probably do, but just in case, who listens to the Motley Fool Money podcast? Anybody? Excellent. Welcome to our very special, no, I'm kidding. It's not our Sunday mailbag edition, but this is Andrew Page. Andrew, I have a question for you.
Yes, I can guess what it is.
What's the question?
What is Strawman?
That is exactly
there
right.
There you go,
what
yeah.
exactly is Strawman.com?
We are a private online investment club.
That sounds like something I really should remember.
You should remember that.
I should remember that. Thank you for joining us. I used to work with Andrew many years ago. We've been mates ever since, and we have spent a lot of time thinking about hidden gems. In fact, Motley Fool has a service called Hidden Gems. Andrew spends a lot of time on strawman.com talking about hidden gems. By the way, I've never done something like this in the round, so I'm going to try and keep turning around. And if I forget, yell, wave, clap, do something to get my attention, because I will forget. Andrew's better than me, he won't forget, but I will forget. So I apologise in advance. Mate, let's kick it off.
Okay.
What is a hidden gem?
It's whatever you want it to be, I suppose, but there's no formal definition.
Right.
But there's 2,120 odd companies on the ASX. Everyone talks about the top 50, the top 100, and there's a very long, fat tail of companies at the smaller end of the spectrum. They're often called small caps, or nano caps, or micro caps. And the reason that they don't get much coverage is, well, the big banks just don't have enough of a team to cover 2,000 companies. But also there's not enough liquidity there. So someone like yourself, Scott, who's got a $2 billion portfolio, and you want to like put a lazy 20 million into one of these companies, you can't do it. Now, the truth of the matter is that they're also typically branded as pretty risky, pretty speculative. And I think that's actually pretty true for the most part, but there are some hidden gems amongst all of them.
Now I get it.
Yes.
Nice, nice. Who here invests in small cap stocks? Show of hands. Who only invests in small caps? Fascinating. Awesome. Mate, why would someone want to go outside the range of where the big banks won't go? The big analysts, the people we can rely on, the newspaper coverage.
Yeah.
I'm figuring a lot of good free detail, plenty of places on these big companies.
Yeah.
Why take the risk?
So first of all, I take issue with the fact that they are risky.
I'm very surprised. Tell me why.
And it comes from academia, and academics will measure risk by volatility. And as Warren Buffett will tell you, or the next Warren Buffett is about to tell you, risk is not volatility, volatility is not risk. So I would get rid of that. I would also say that you look at the top, we talked about this recently, within the top 20 of the ASX, there's absolute dog poo within that. And I say that objectively, companies that have just eroded shareholder wealth for a long, long period of time. And at the other end of the spectrum, you've got companies that they might be small or nano or micro, but are profitable, cash flow positive, strong balance sheets, compelling products, et cetera, et cetera. And the other thing I would say is as well, it's all relative. So if you want to take one of these companies and you want to put it next to BHP Billiton, it's tiny. But we're still talking about a company that might be $70 million worth. And I don't know about any of you guys, but if you had a $70 million company, I don't think any of us would consider that to be small. But to answer your question, why would you look at it? It's because no one else is looking at it. You've basically got yourself and a bunch of idiots on hot copper. And that's who you're competing against. And you've literally, it's not about being necessarily the smartest person in the room, you just have to be in that top 51% or so. The big end of town, who frankly aren't that good at what they do anyway, but they just physically can't. There's not enough money. If they wanted to make a 5% allocation on their portfolio, they'd buy every share there and they'd just blow the thing up. So you're competing against mostly ill-informed investors, and that is a huge edge if you're prepared to do a bit of work.
I want to take Andrew's first point about the top end of the market. What's really helpful is the guys from Equity Mates have put some scrolling screens around this room, and if you're listening on audio later, just trust me, that's what's happening. You'll see the ASX 200 come up. And there's not 200 companies listed, but some of the biggest companies on the ASX go scroll through that screen. 2 of the big 4 banks over the last 5 years have had a negative return. Not have lost to the market, have had a negative return. Add a couple of others. QBE was there with plus 12. I think it might have been Telstra might have been the other one. I own shares in Telstra. Also plus 12% over 5 years. It's a very long time to wait to roughly keep up with inflation, right? And that's not what we're here to do. So even if the companies themselves aren't necessarily terrible businesses, and they're not, the returns you are able to get from those companies aren't justified because they're big. One of the worst things your broker can tell you is, it's a blue chip, you should buy it. Right? Blue chip's supposed to mean great and big and safe and reliable and worth investing in, right? That's what they say, except when you look at the returns, and again, check out these screens as we're talking. When you stick a look at me and Andrew, look at the screens. Some of those returns are very, very pedestrian. Now, some are great, by the way. And so the key is not to say you should never invest in large businesses. Or, to Andrew's point, don't invest in all the small ones either. But have a think about what you're getting for your money in terms of the company, the quality of the business, the growth potential, we'll talk about that in a minute, and the valuation you're paying. If you've got a company not many people are looking at, it's a very good chance it's going to be mispriced by the market. Now, it can be mispriced aggressively. Who's owned some tech stocks that have fallen in the last 12 or 18 months? Everybody? Yeah, right? Painful as hell. Now, maybe they were expensive then, maybe they're cheap now, maybe both are true, maybe neither's true. So I'm not saying everything again. These are not blanket rules. But to Andrew's point, when you're looking for businesses that are going to, or hopefully going to beat the market, you've got to do something different to the market. That's rule number one. And that's painful and that's hard. And that's why tech stocks are suffering right now. You've got to do something different to the market, and you've got to find a price that's worth paying. And that top 20, the chance you find a price that's really attractive when there's a dozen major brokers being paid squillions of dollars and driving to work in their Mercs, they're following those businesses, they're not going to be right, they're going to be wrong very often, right? Because that's their job. And these businesses, I mean, Woolies, Telstra, Coles, they're not going to, everyone, all of us here could pick their growth trajectory within a couple of percentage points over the next 3 or 5 years. Why? Because they're pretty pedestrian businesses, which are great, by the way. Nothing wrong with that. But if you know what the future's likely to look like, the chance you're going to get a great opportunity to buy those shares at a really good price, probably not there. Now, I want to talk to you, mate, again, about risk. You tell me that risk is volatility.
No, I wouldn't.
What would you tell me?
Risk is not knowing what you're doing.
Correct. So, that is the key. That's the first thing, right? When you're buying small caps, you've got to do your work, you've got to do your research, you've got to do the analysis, make sure you get it right. So that's number one. But isn't it also true that small businesses, by definition, are simply less able to withstand some of the slings and arrows of outrageous fortune? The way the market tends to work, the way businesses tend to work, if we have a recession, God forbid, touch wood, in the next 12 months, if I've got a Woolworths-sized balance sheet, I'm doing pretty well. Yeah. If I'm a little tiny micro, nano, something else cap down here, and things go against me for 6 months, I don't know, someone here might say, I will be devil's advocate and say, wouldn't I be better off owning Woolies, because I at least know it's going to get through to next year, and take a risk with these little small caps that are blown about by the wind? Yeah, so for the most part, yes. And this is the trouble, is that, and this is what this is the fault of the brokers, is that they put these things in baskets. So a small cap is a small cap is a small cap, but you've got an industrial manufacturer there, you've got a retailer, you've got a tech, I mean, they're completely different companies. And to be fair, a lot of them are cash flow negative. They're going to rely on the good fortune of investors to, when they rattle the tin, to put more money into it. So that's generally true, but it's not all true. And there are dozens and dozens of companies, we focus a lot on Strawman on them, which again, they just go outside of the mold. In the Coinbase tent later on this afternoon, I'll give you a pitch for one, which is strong balance sheet, cash flow positive, defensive industry, strong tailwind.
it's a 40 million market cap company. You might be lucky to see $20,000 being traded on that thing a day. So again, if you're Warren Buffett or you're Scott Phillips, that's a problem. But for the rest of us, it's actually quite easy. You can build up a decent position over time. It's absolutely not always true. And it's in those gaps that you'll find the opportunity.
For the record, I work for a business. He owns one. He's the rich guy over here. He's got the next Warren Buffett t-shirt on. So Andrew Page, hit him up for, he'll buy you a coffee, he'll give you some money.
Some Bitcoin.
Yeah, don't take his Bitcoin. Not only will he cry, no, I'm kidding. He's going to talk later about Bitcoin, by the way, which I am looking forward to. I'm going to be in the front row. I'm the one throwing popcorn, so go along to that one, as well as get a microcap pitch. So we talked about that sort of stuff, mate. You've kind of given a hint of some of the things that you should look for as an investor.
Yep.
But before we get there, you've also talked about some of what's happened over the last 12 or 18 months. And I think it would be a shame for us to do small caps without doing that, right? Because there is a sense, and this is not always untrue, but nor is it always true, we are so driven by the market's own sentiment.
Yes.
We feel like we're 20, 30, 40, 50, 60, 70% poorer over the last 12 or 18 months because the market tells us we are. Now that's objectively true on one level, right? Selling your shares today, you might get 2/3, 1/3 of the money you bought them for 18 months ago. Objectively poorer if you cash out today. On the other hand, the market is not always right about this sort of stuff. And you talked about some of the reasons why some of these companies are being bid down.
Yep.
And I think that's why it's so important not to think about small caps as a group, or even tech as a group. Think about tech. What is tech really? And what do we call tech companies? There's e-commerce businesses, there's analytics businesses, they're tech because they use the internet, but who doesn't these days?
Every company's a tech company,
right? Exactly. So that's important. So there's the market's own sense of where we are, where we're going. And our job as individual investors, and never more so than in the small cap space, is to understand for ourselves what a business is actually worth, fundamentally worth. Not what the market's telling us it's worth. And here's the other thing, right? We all feel poorer when shares are down, yes? Who of us bought shares because we thought the market was right about that company and it was already fairly priced? Anybody? No. Why not? Because we thought we were buying shares that were cheap because we thought we'd beat the market. One of those weird human things that our brains do, I'll talk about something like this later, by the way, he doesn't get to do a plug if I don't get to do a plug, is we think the market's wrong when we buy shares. The second after we buy them, what do? We take our advice from the market. We jump on our brokerage account and say, what's it worth now? It was cheap yesterday when I bought it. Now it's down 2%. Oh my God, I'm an idiot. I've made a mistake. Really? We thought the market was wrong a day ago, a week ago, a month ago, a year ago. And now we're letting it tell us that it's right. You've got to get that out of your heads. And I know you all probably know that because you've been following the market. You're here on a Saturday, which is spectacularly great, by the way. And thanks for coming along. But think about that when you think about how you should consider your portfolio and the value of the shares in that portfolio. By the way, don't be stubborn. If your shares are down 90% because this business just sucks, don't pretend that it's going to bounce back because the market bounces back, right? You're not necessarily right because the market disagrees with you, but nor are you necessarily wrong. So, Andrew, if I'm going to assume the market's wrong, what attributes am I looking for to tell me that these are businesses worth owning in the small cap space?
You've got to understand the business before you can make, price and value are super important, but they're the last piece of the puzzle. How can you even think about if something has value or not if you don't understand what it is, right? So you've got, and it's all the dumb questions. What do they do? What do they sell? How are they different? What pricing power do they have? What unit economics are there? You can almost have a checklist. In fact, checklist investing is a really good idea. Just jot down things that are worth having a look at. What's the balance sheet like? What's the cash flow statement like? Et cetera, et cetera. So you fold all of that together. And you've also got to remember that just because the market is down, it's not cheap. And I think this is very pertinent where we are right now, because we have seen, to your point, a lot of particularly growth stocks, particularly tech stocks have come back a lot. But they're still pretty expensive. I'll pick on a bigger one, which is Xero. And I think Xero is a great company. It's probably one of the best companies on the ASX, a phenomenal business. And it's fallen a lot. It's still 9 times sales. Not earnings, like sales. So in other words, they got rid of all of their expenses, everything they sold, they returned to shareholders. It'll take you 9 years to get your money back, forgetting inflation, forgetting opportunity costs, forgetting everything else. So I think one of the dangers is that we see at the moment is it's down 30, 40, 50%, ergo it's cheap. No, it's not. Well, not necessarily. It's cheap because it's cheap relative to your analysis. So again, the great man himself, forget about the market. If this was a private company and I was a billionaire and I was going up to think about buying this thing wholesale, what am I going to look at? Well, is it going to be around in 5 years? What do the earnings look like roughly at that point in time? What are some of the capital expenditure requirements? Everything that you would ask as a business person, nothing that you would ask as an investor, right? And again, it's a Buffett quote, it's a great one. I'm a better investor because I'm a businessman. I'm a better businessman because I'm an investor. And they're the same thing. And then finally, in fact, you'll go through this process and you'll spend most of your time just throwing it in the bin. And our job as investors should be throwing stuff in the bin because there's 2,000 companies, and I'd argue 10 or 15 is tops, is all you need to be very well diversified. You can argue that maybe 20, 25 if you want to, but that's literally saying that, like 90% plus you need to get rid of. So be very fussy. And then once you find something that you think, this is a really great business, I want to own this, then you can think about trying to come up with some pricing. And that is a whole other topic that we could spend the next 6 weeks talking about. But yeah, hopefully that answers the question.
It does. We won't spend time talking about valuation. We will spend time talking about, though, the future of these businesses. Because as investors, our job is to think about the risk and the return, right? Everyone knows that, yeah? By the way, there's nothing, you're going to hear nothing new this weekend. Nothing new today at all. You won't hear a single thing that's new. Hopefully you'll hear some people put some really interesting concepts in really approachable, understandable ways. But there is nothing new. Warren Buffett has been investing the same way for 50 years, right? There is nothing new in investing. At a level of the principle and the process you need to go through to understand the companies. Different technology, sure. Different brands, sure. Different businesses, absolutely. But the actual approach of buying something for less than it's worth and then valuing, hopefully getting some value creation when it becomes hopefully worth at least what it's worth and then maybe even more than that, that's investing 101, and that has not changed in a century, right? So I'm sorry to disappoint you if you're here for something brand new. Hey, by the way, we got the secret to investing. It turns out it's this. We're not going to have that for you. Risk and reward.
I'd be on a yacht somewhere if I had the secret
totally
to
right.
investing.
The other thing to think about is probabilities, okay? And think about the probabilities and the risk and reward side by side, because probabilities are all about expected value or the payoff you get. There are plenty of people in this room and elsewhere who will never see money back from some of the small caps that have fallen over the last 18 months. Some of the reasons Andrew's already talked about.
I won't see some money back from some of the investments I've made in the last 18 months.
Right.
It's normal.
And that's the point. So think about your portfolio not as individual companies. We do that all the time, right? I work for the Motley Fool, we give stock tips, that's what we do. People buy one company and say, Phillips, you're an idiot. I lost money on that stock, you're a fraud, I want my money back. Okay? Now, I don't like making mistakes, Andrew doesn't like making mistakes. I'd rather make a mistake with my own portfolio than my service, by the way, because I cost fewer people less money. But I'm going to make mistakes, I'm going to be wrong, life's just going to happen. Just unexpected things, expected things, bad analysis, bad luck, circumstances, competitors, all that stuff happens. That's what investing is about. But the idea of probability is to say the expected value of these all in a group, if and when they pay off at a range of probabilities, is going to make me money. So it's not about avoiding all of the potential losers, otherwise you'd be in cash. We wouldn't all be here, right? We'd be down at the bank at some bank conference. Because money in the bank is at least money in the bank. Now, by the way.
That's the value of ETFs, right? You look at these boards, there's a lot of red mixed in all of there, but overall, tends to be pretty decent.
There you go. So think about the probability of your investments as a portfolio, not as individual companies, which is not an excuse to buy 5 lotto tickets and hope one of them wins, because it doesn't work that way either, because the probability is not in your favor. So you've got to try and find businesses that probabilistically are going to create value for you, knowing that some won't. And that the experience of having those, the presence of the losers, doesn't suggest to me, to Andrew, although he can speak for himself, that you've got a bad strategy. It's the return of the strategy overall. In fact, if I tried to de-risk my portfolio, or the services I run for our members, or Andrew's strawman portfolio, what do you call it? Strawman thing?
Portfolio?
Portfolio,
yeah,
there
sure.
you go.
Index.
Index, thank you. You're going to have those realities, right? That is investing 101. If you try to de-risk it all, you won't pay anything. Because the things that have made me money are exactly the same, probabilistically and structurally, as the same things that have lost me money. I've either been wrong or unlucky, or the competitors have been better, or whatever's happened. But if I said, I'm not going to do that thing anymore, because that lost me money last time, I'd miss on the thing over here that made me money. Right? That's really, really, really important.
Can I just add one
Please.
thing here? There's a bit of nuance here as well. Losing money isn't, if you buy something and it goes down 20%, well, firstly, you can say I haven't lost money until I sell. which is a really nice trick. But it's actually, there is some truth to it.
Yeah,
and I would say, like, use myself as an example, of some of the best investments I've ever made. I bought them, and then on day 2, they dropped. And then like 6 months later, they're down like 30%. It just happens. So you're not, just because the share price has fallen, you're not wrong. Maybe the market just hasn't realized it yet. In fact, you could go and look at some of the really great investments over the years. Like Amazon's the one that everyone goes to because it's such a great example. But you could have picked the 52-week high in 2002, in 2003, in 2004, and bought at that high and still done insanely well. So obviously seeing it fall after the fact. So and I think a lot of people make this mistake. They buy for all the right reasons, it falls, and they go, I was wrong, and then they sell, and then they look back 3 years later and it was to the moon. So you're not necessarily wrong, you might be wrong. That's the time to sort of just double check the thesis, have I got everything in place? Sometimes, oftentimes, it's actually an opportunity to buy more. Again, provided that the thesis still checks out. If it's broken, get the hell out. And get out decisively.
You're looking for real businesses. You're looking for businesses that actually do a thing. Don't laugh. There are many, many businesses on the ASX that have plans to do some things. Think about every gold explorer and pharmaceutical company you've ever heard of. Plan to do a thing. Just because some actually get it right, by the way, also doesn't make it worth investing. The existence of Fortescue does not justify an investment in every single gold explorer, right? Did fantastic. Trigger's done a wonderful job.
248%.
There you go. Don't buy every gold explorer just because one of them makes some money. So a real business actually doing a thing. And then it comes down to your conviction after that. When I say doing a thing, I'm talking about sales, revenue. Right? Then it comes down to a trade-off. To my mind, I don't really disagree. Think about a continuum, the old XY axis, right? For those of us who did maths in school, you still remember that stuff? On one axis, you've got the size of the payoff. On the other, you've got the, let me call it maturity of the business. Every business has an idea, has an infinite payoff, potentially, right? Equity Mates, before these guys sat in a room and said, why don't we? And now here we are, yeah? But for every one of those, there's like 2 other blokes in another pub who said, why don't we? And they never did. Or it went broke. Or they got 15 listeners to a podcast, which is great, but not Equity Mates, right? Every time you do that, you're comparing the size of the potential payoff against the maturity of the business. And by the way, that same curve is a probability curve, more or less. The earlier stage the business is, the bigger the potential payoff. But that's lotto ticket stuff. I buy a lotto ticket today, I can possibly win $100 million next week. Huge payoff. Chance of it? 0. So close to 0, it rounds to 0. After about 4 decimal places, your chance to win the lotto is still 0.
There's something, right? There's other nuance there too, of course, which is, I should have mentioned this as in answer to your first question, why small cap companies, is that there's obviously much more growth potential that's there. The mistake is to think that you have to be in on day one to do well. And as Scott's rightly pointing out, is that every company has, hope springs eternal. But you can wait and you can be late on something. I mean, imagine being late to Afterpay by a couple of years. You've still done okay, right? Imagine being late to any of these like ones that have knocked it out of the park. But is that risk-reward trade-off? So you are getting in late, but you are getting in a stage where the risk is much, much, much lower. Might say something about that in the Bitcoin talk later on. But it's valuable, and it's this mistake, and then what will happen is you'll see these companies, okay, good story, good tech, whatever, it's gone up 50%, 100%, 200%, and the natural reaction then is to go, oh, it's too late. But again, if these companies genuinely have traction, and they've genuinely got a large addressable market, and real momentum in their sales and that, actually you can still do extraordinarily well, but at a much lower risk. You're not doing that lottery ticket investing.
I will give you one tip that I use really regularly to think about the way I invest in smaller businesses, younger stage, earlier stage business, and I'll ask Andrew for a tip from him as well. If you think about, for those who, hopefully you're all familiar with the profit and loss statements, relatively speaking, you will know that in the cost section, there's a whole lot of fixed costs, right? There's one Andrew and one Scott. If we double our business, if we halve our business, it's one Andrew and one Scott. We don't have a business, but if we did, that's what it would look like. Now, our costs in that section are relatively high and relatively fixed. The variable cost of production for a lot of businesses can be massive or can be tiny. Think about software companies. The 5th copy of the piece of software and the 100th copy and the 1,000th copy and the 1,000,000th copy, the distribution of that is almost exactly 0. Advertising costs, yes. Development costs, yes, whatever. The distribution cost of that is zero. If you have a business that is unprofitable or moderately profitable, a certain level of scale, and that sales line continues to take off, and they hold their costs relatively fixed, what happens? The bottom line, the top line grows, the bottom line can potentially grow much, much, much faster in multiple percentage terms than the top line. So I'm looking actively for businesses that are just before profitability or just after profitability. I don't mean just as in days, I mean just as in years. But as they continue to scale, that money flows really quickly to the bottom line. And that's one great way you can find companies that are profitable or almost, that are selling stuff and growing really quickly and have a big, big, big sales and profit potential. And if the market's not valuing it for that, and some of them are, that's a great place to look. One tip for you, Andrew.
I'm going to go something super small, $10 million market cap, hyper illiquid. So if everyone buys it, it's going to pop it, and I'm going to make a fortune, and then I'm going to sell and get out.
Love that. Great way to
No.
A massive thanks to Andrew and Scott. You've done a lot of job. Thanks, guys.
Thanks, mate. Thank you.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.